Have you ever wondered how banks make their money? While the banking business itself can be quite complex, the ways in which banks make money can be surprisingly easy to understand. Here's a quick rundown of the two main ways banks make their money and some key details to know about each one. Diversified banks make money in a variety of different ways, however, at the core, banks are considered lenders. Banks generally make money by borrowing money from depositors and compensating them with a certain interest rate. The banks will lend the money out to borrowers, charging the borrowers a higher interest rate and profiting off the interest rate spread. Additionally, banks usually diversify their business mixes and generate money through alternative financial services, including investment banking and wealth management. However, broadly speaking, the money-generating business of banks can be broken down into the following: interest income, capital markets income, fee-based income. Interest income. Interest income is the primary way that most commercial banks make money. As mentioned earlier, it is completed by taking money from depositors who do not need their money now. In return for depositing their money, depositors are compensated with a certain interest rate and security for their funds. Then, the bank can lend out the deposited funds to borrowers who need the money at the moment. The borrowers need to repay the borrowed funds at a higher interest rate than what is paid to depositors. The bank is able to profit from the interest rate spread, which is the difference between interest paid and interest received. Importance of interest rates. Clearly, you can see that the interest rate is important to a bank as a primary revenue driver. The interest rate is an amount owed as a percentage of a principal amount, the amount borrowed or deposited. In the short term, the interest rate is set by central banks that regulate the level of interest rates to promote a healthy economy and control inflation. In the long term, interest rates are set by supply and demand pressures. A high demand for long-term maturity debt instruments will lead to a higher price and lower interest rates. Conversely, a low demand for long-term maturity debt instruments will lead to a lower price and higher interest rates. Banks benefit by paying depositors a low interest rate and being able to charge borrowers a higher interest rate. However, banks need to manage credit risk, which is the potential of a borrower to default on their loans. In general, banks benefit from an economic environment where interest rates are falling. When rates are low, banks pay their depositors lower rates, but loans are still lent out with a significant spread. Additionally, when rates are low, there is more incentive for companies and individuals to borrow, increasing the demand for loans. The opposite also holds true. When rates are high, loan demand tends to fall as loans are more expensive and the economy tends to be at a stronger point of the economic cycle, meaning that companies should be doing well and not needed as much financing. It also means that depositors might shift from other investments towards bank deposits, which then squeezes a bank's interest margin. Capital markets related income. Banks often provide capital markets services for corporations and investors. The capital markets are essentially a marketplace that matches businesses that need capital to fund growth or projects with investors with the capital and require a return on their capital. Banks facilitate capital markets activities with several services, such as sales and trading services, underwriting services, M&A advisory. Banks will help execute trades with their own in-house brokerage services. Furthermore, banks will employ dedicated investment banking teams across sectors to assist with debt and equity underwriting. It is essentially assisting with raising debt and equity for corporations or other entities. The investment banking teams will also assist with mergers and acquisitions, M&A, between companies. The services are provided in exchange for fees from clients. Capital markets related income is a very volatile source of income for banks. They are purely dependent on the capital markets activity in any given time period, which may fluctuate significantly. Activity will generally slow down in periods of economic recession and pick up in periods of economic expansion. Fee-based income. Banks also charge non-interest fees for their services. For example, if a depositor opens a bank account, the bank may charge monthly account fees for keeping the account open. Banks also charge fees for various other services and products that they provide. Some examples are credit card fees, checking accounts, savings accounts, mutual fund revenue, investment management fees, custodian fees. Since banks often provide wealth management services for their customers, they are able to profit off of the fees for services provided, as well as fees for certain investment products such as mutual funds. Banks may offer in-house mutual fund services to direct their customers' investments towards. Fee-based income sources are very attractive for banks since they are relatively stable over time and do not fluctuate. It is beneficial, especially during economic downturns, where interest rates may be artificially low and capital markets activity slows down. At their core, banks make money in two main ways: commercial banking and investment banking. Commercial banking refers to products like accounts and mortgages, while investment banking refers to services like corporate transactions and wealth management. Here's what each of these terms means and the different revenue streams banks create within them. Commercial banking refers to the banking products and services that banks provide to individuals and businesses. These financial services include checking and savings accounts, mortgages, auto loans, personal loans, credit cards, lines of credit, and more. They also include adjacent services such as safe deposit boxes, brokerage accounts, financial planning, and more. Investment banking refers to services a bank provides to corporations, governments, high net worth individuals, and other entities that go beyond commercial banking activities. Investment banks advise clients on mergers and acquisitions, corporate finance transactions, and restructurings. They facilitate things such as initial public offerings, IPOs, and debt offerings, and also engage in proprietary stock, bond, and currency trading activities. And, finally, investment banks offer wealth management services to corporations and high net worth individuals. Banks make their money in a variety of ways, but most can be classified as either fees or interest income. Let's take a look at fees first. There are many different types of fees banks can collect, both on the commercial banking and investment banking sides of the business. Here's a rundown of some of the most common fee categories. Overdraft or returned item fees. Banks typically assess a charge if a transaction makes a customer's account go into the negative or if it is rejected due to lack of funds. A typical fee for this is $30 to $35. Monthly account fees. With checking accounts in particular, it's common for a modest monthly fee to be assessed, say $10, to cover the bank's costs of maintaining the account. There is usually a way for account holders to avoid the fee, and it is often something else that will make the bank money, such as a certain volume of debit card transactions. See interchange fees below. Interchange fees. Interchange fees are typically charged when you use a bank's credit or debit card to make a purchase, but it's the merchant's bank that pays it, not you. Say you have a Bank of America credit card and use it to make a purchase at a retail store. The retailer's bank must pay an interchange fee to the bank that issued the card, in this case, Bank of America. The fees paid by merchants on credit card payments are commonly referred to as swipe fees, and interchange fees are a part of them. Loan fees. Banks often charge origination fees when giving loans. For example, it's not uncommon to pay an origination fee of $1,000 or more for a large loan such as a mortgage. Other account fees. When you look at your checking or savings accounts fee schedule, there is probably a list of things you could be charged for. In addition to those already discussed, common fees include non-bank ATM withdrawal fees, international debit card transaction fees, fees for money orders and cashier's checks, and wire transfer fees. Investment banking fees. Banks that have investment banking operations make money from advisory fees they charge to clients. For example, if a company wants to go public and complete an IPO, an investment bank would get advisory fees for facilitating the process and advising the company on the best course of action. Net interest margin. When it comes to commercial banking, Net interest margin is the primary revenue generator. Net interest margin, or NIM, refers to the spread between the interest income banks take in on loans and the interest the bank pays for deposits after the bank's costs are accounted for. For example, if a bank has a $100 million loan portfolio and its net income from those loans is $2 million, it has a net interest margin of 2%. Net interest margins depend on a few factors such as the efficiency of the particular banking institution and the types of lending the bank specializes in. They also depend on prevailing market conditions. Specifically, lower market interest rates typically translate to lower NIM, and higher rates tend to produce higher NIM. How credit unions work. Unlike traditional banks, credit unions are non-profit businesses. They charge interest and fees, just like banks, but they are typically only focused on covering their expenses and not on delivering large profits to shareholders. Credit unions are technically owned by their members, and their mission is to give members the best rates, fees, and yields on deposits they can while covering the costs of their operations. The bottom line is that there are many different ways a bank can make money, but each institution is different and will generate revenue in different ways. Banks are privately owned institutions that, generally, accept deposits and make loans. Deposits are money people leave in an institution with the understanding that they can get it back at any time or at an agreed upon future time. A loan is money let out to a borrower to be generally paid back with interest. This action of taking deposits and making loans is called financial intermediation. A bank's business, however, does not end there. Most people and businesses pay their bills with bank checking accounts, placing banks at the center of our payments system. Banks are the major source of consumer loans for cars, houses, education, as well as main lenders to businesses, especially small businesses. Banks are often described as our economy's engine, in part because of these functions, but also because of the major role banks play as instruments of the government's monetary policy. How banks create money. Banks can't lend out all the deposits they collect, or they wouldn't have funds to pay out to depositors. Therefore, they keep primary and secondary reserves. Primary reserves are cash, deposits due from other banks, and the reserves required by the Federal Reserve System. Secondary reserves are securities banks purchase, which may be sold to meet short-term cash needs. These securities are usually government bonds. Federal law sets requirements for the percentage of deposits a bank must keep on reserve, either at the local Federal Reserve Bank or in its own vault. Any money a bank has on hand after it meets its reserve requirement is its excess reserves. It's the excess reserves that create money. This is how it works. Using a theoretical 20% reserve requirement, you deposit $500 in your bank. Your bank keeps $100 of it to meet its reserve requirement, but lends $400 to Ms. Smith. She uses the money to buy a car. The Save You More car dealership deposits $400 in its account at their bank. Their bank keeps $80 of it on reserve, but can lend out the other $320 as its own excess reserves. When that money is lent out, it becomes a deposit in a third institution, and the cycle continues. Thus, in this example, your original $500 becomes $1,220 on deposit in 3 different institutions. This phenomenon is called the multiplier effect. The size of the multiplier depends on the amount of money banks must keep on reserve. The Federal Reserve can contract or expand the money supply by raising or lowering banks' reserve requirements. Banks themselves can contract the money supply by increasing their own reserves to guard against loan losses or to meet sudden cash demands. A sharp increase in bank reserves, for any reason, can create a credit crunch by reducing the amount of money a bank has to lend. How banks make money. While public policymakers have long recognized the importance of banking to economic development, banks are privately owned, for-profit institutions. Banks are generally owned by stockholders. The stockholder's stake in the bank forms most of its equity capital, a bank's ultimate buffer against losses. At the end of the year, A bank pays some or all of its profits to its shareholders in the form of dividends. The bank may retain some of its profits to add to its capital. Stockholders may also choose to reinvest their dividends in the bank. Banks earn money in three ways. They make money from what they call the spread, or the difference between the interest rate they pay for deposits and the interest rate they receive on the loans they make. They earn interest on the securities they hold. They earn fees for customer services, such as checking accounts, financial counseling, loan servicing and the sales of other financial products, example insurance and mutual funds. Banks earn an average of just over 1% of their assets, loans and securities, every year. This figure is commonly referred to as a bank's return on assets, or ROA. Government's earliest leaders struggled over the shape of our banking system. They knew that banks have considerable financial power. Should this power be concentrated in a few institutions, they asked, or shared by many? Alexander Hamilton argued strongly for one central bank. That idea troubled Thomas Jefferson, who believed that local control was the only way to restrain banks from becoming financial monsters. We've tried both ways, and our current system seems to be a compromise. It allows for a multitude of banks, both large and small. Both the federal and state governments issue bank charters for public need and convenience, and regulate banks to ensure that they meet those needs. The Federal Reserve controls the money supply at a national level. The nation's individual banks facilitate the flow of money in their respective communities. Since banks hold government-issued charters and generally belong to the Federal Bank Insurance Fund, state and federal governments have considered banks as instruments of broad financial policy beyond money supply. Governments encourage or require different types of lending. For instance, they enforce non-discrimination policies by requiring equal opportunity lending. They promote economic development by requiring lending or investment in banks' local communities, and by deciding where to issue new bank charters. Using banks to accomplish economic policy goals requires a constant balancing of banks' needs against the needs of the community. Banks must be profitable to stay in business, and a failed bank doesn't meet anyone's needs. Thank you for watching this video.